yelling at Yellen, yelling at Yellen, yelling at Yellen, yelling at Yellen, because everyone's yelling at Yellen, they're screaming that there's trouble coming. I'm big on the US, and someone was coming back with just the nonsense about China and the BRICS and them creating their parallel currency to usurp the dollar. Ain't gonna happen, people. It is a message to Bank of America. Can you give us an update? Could you tell me what you've been doing? But could you just give me an update? Or could someone on Wall Street do their damn job and ask these damn questions? No one cares. Last 18 months, dollar yen, or the yen, has devalued the best part of 40%, which is astonishing. It should be front page news. It's telling you that something is profoundly wrong.
It's Thursday, 2nd of May. With me today, I have a long-standing friend of the show, the asset capitalist Hugh Hendry. I'm looking forward to launching into a macro maze. Hugh, what a delight to have you back.
You are the host that is most generous, and above everything else, this backdrop. Wow.
It's amazing, isn't it? A beautiful view over the city of London. Yeah. So last time you were in to see us in January, which actually seems like a long time ago, but wasn't that long time ago. We spoke a lot about dollar yen and gold and other things. So what's changed and what's your outlook these days?
Well, I guess there's an update. The curiosity that I had back then, and heavens, back then I was suffering from the flu. I looked like 100 years old. But the fascination for me was dollar yen, and I was, I used to, jokingly or otherwise, describe myself as a paranoid schizophrenic when I was a hedge fund manager, which is to say that I heard voices in my head. Now, the voices in my head would be chart formations. Mm-hmm. I looked at hundreds, if not thousands, of charts every week in a coordinated manner. Different indices, stock indices, bond futures, you name it, commodities, and it's like calling a friend. The market's my friend, and actually reveals a trace source. And I was curious about that, and I would take investment decisions based on the voices, the chart formations. They would be initially sized kind of modestly, to satisfy my curiosity, but that would then direct my intelligence team
to then do more work,
to verify or disprove. And so and then the paranoia would be, oh my God, I've just spent other people's money on a whim, on a fancy, and that's where we were in January. I was saying to you that I could hear $200 yen. That was the whisper when I looked at these charts, and that was very, very provocative. And again, I was drawing comparison with one of the legends in the macro space, Bruce Covenor, who founded Caxton and is now retired. Funnily enough, he had a super huge pad in St. Bart's, which he sold a few years back. But I've always admired Bruce for his work, and he had similar postulation. Heavens, back 15, 20 years ago, and he was saying, I can feel like dollar yen's going to be 100, and that was like a preposterous thing because dollar yen was above 200. So that's going back. Now, since then, there's been a rip in the dollar versus dollar yen, and over the last 18 months, dollar yen, or the yen, has devalued the best part of 40%, which is astonishing. That's more than when sterling got evicted from the exchange rate mechanism back in 1991-92. And that was a big deal. And this is even bigger because Japan is an enormous, what's the third or fourth largest economy in the world. It should be front page news. It's telling you that something is profoundly wrong in the international financial plumbing system, and yet not much. And the other thing is, up until this is quite timely because this week on Monday and I believe yesterday, they finally come in with some intervention, try to protect the 160 level. I don't think they can, and I'll try and describe why. I think it's still going to slide. But it's time to discuss the ramifications of that, because they run deep, and that's why I wanted to focus on it back in January, and that's why I hope I don't, this is not a repetition of January. If I succeed with this, if I be rather preposterous, but I feel like what I'm trying to set out is the framework of a history book that your kids will read in 50 years' time, telling you what just happened. So I'm going to try and preempt and suggest what might happen. And this is the first major solar flare, this dollar yen. And it has profound repercussions with its closest neighbors, South Korea and China.
Yep.
In the last 10 days, the Treasury and central banks leaders of both South Korea and Japan had been on the phone. I think they were even in Washington with Janet Yellen. And so there's back channels, and there's a lot of kind of going, this is. I mean, 40% devaluation takes you to Taibat.
Yeah.
Takes you back to the Tiger crisis. That's not a hedge fund. That's the Tiger economic growth.
96, 97?
That was 97, 98.
Yeah.
It coincided then Russia came over and you had a sovereign debt default. And again, that forced actions out of the global central banker, the Federal Reserve. So it's all timely. And again, if we're touching upon dates, of course, this you mentioned, we're in the matrix, we're in the maze of my mind. I'm going to desperately try and be clear. But so let's take notes. 1997, 98. You could go back a decade earlier to the Plaza Accord, and the ramifications and maybe the final conclusion of the imperial circle that Soros described the US being in between 1982 and 1987, which was a kind of reflexive, virtuous circle where US risk asset prices were bid higher, and it attracted more capital from the outside world, and it reinforced. And then we're going to go much further back. There are always sevens. We're going to discuss the period 20. It's always end of decade. 1927 to 1930. So a lot to discuss. So, and again, I sound bearish. I'm talking about the end of the world. I'm not. I'm not a Marxist. It says asset capitalism, I'm not an acid Marxist. My son thinks one day I will be, but I'm set to disprove him.
You have to sell the place in St. Bart's first.
I am massively bullish on human ingenuity. And actually, I did an interview with someone, and about and I'm big on the US. And again, we're in one of those situations, one of those bullish constructs. There's an old saying, I think it comes from the commodity pits, that the most bullish setup is that when those who know it best love it least, you gotta be buying. And that was very, very true back in 2002, 2003. Even all the gold guys, you'd had 3 decades and they'd just been crucified. It was very, very true in 2000, slightly later, 2005 or so, in agriculture. Farmers were selling land, they'd just given up. And people gloat about how much they're down on America, and of course the presidential election. I mean, look at the UK. Oh my God. We don't have presidential elections, but the prime ministerial thing is just you're just left with clowns to the left to me, jokers to the right. I'm stuck in the middle with these bozos. So I'm big on the US, and someone was coming back with just the nonsense about China and the BRICS and them creating their parallel currency to usurp the dollar. Ain't gonna happen, people. It ain't gonna. But they've got all these PhDs. They've got a factory system churning out PhDs, and it came to me that we've made a lot of that redundant by. I mean, we're just not getting the transformation in AI, right? Yeah. And AI takes. I'm a right hemisphere, as I guess it was on screen. I'm a right hemisphere guy, and this could be my time, because you don't need a left hemisphere.
Exactly.
That's what AI will do it a million zillion times better than you. And I'm sorry, folks, but you young folks, but if you've just done a PhD, oh my God.
In computer science.
Oh God, even worse. But
Exactly.
you don't need PhDs now. But AI takes out that ant factory of PhDs. It's like we got it. So I'm bullish on ingenuity and the fact that this is not a permanent plateau, right? We're going to find another gear and go higher. But I'm trying to describe a currency. So currency systems last a long time, and then they seem to crash. We could maybe trace out 100-year cycle, and so that's why I mentioned to you 1927 and 1930. That's 100 years ago, just about, yeah. And the parallels, we've done the parallels before. The U.S. was China. The U.S. was had industrialized.
Yes.
It was way more competitive than the rest of the world, and of course there was the First World War, which took out the industrial capacity of Europe. The U.S. ran persistent trade surpluses with the rest of the world. Now, back then, the U.S. reinvested that back into Europe, and it actually initially went into productive investment, but at the end it was building grand opera houses in Germany. The money became that was actually speculative capital, and that was one of the warning signs. Fast forward today, the persistency of trade surpluses from mercantilist nations, but let's call it China. Huge the surplus versus their GDP, enormous, and of this even greater magnitude than what we saw back in the 1920s. And it's not to say, oh, it's not fair. It's just to say, actually, the system is not meant to be like that. Like economics is a system which seeks it seeks to resolve disequilibrium with equilibrium. And the whole thing is that you reward, if you're trading more and more successfully with the rest of the world, the system rewards you by making you richer, and you become richer via the external value of your currency allows you to buy more of what the rest of the world produces. And so the rest of the world becomes cheap for your household sector, and you import more, and that's how we restore equilibrium. We've had 30 years of persistent trade surplus, right? So there's a problem in the system. We just have to accept that. Now, that problem comes from there is a designated prearranged economic Chinese manual, which is that they choose to run high surplus savings. Now that's nothing cultural. That's not that they're really cautious people. That typically is wealth transfers, invisible latent wealth transfers from which the government organizes, and it takes money away from the household sector. So you've had negative real interest rates from your bank account forever. You're rewarded in terms of wages, which are far greater than your grandfather or your father, but versus the productivity that you bring to the table, you're severely underpaid. And then finally, they run a deficit in the capital account. They take their surplus savings and they put it into US Treasury bonds and British gilts, and they buy Australian, Canadian, New Zealand risk-free securities. And that actually puts a ceiling on the ability of the currency to rise. And in fact, over the last 35 years, their currency has modestly depreciated. It's gone from about 630 to where are we now? About 730, and it should be the opposite. It should have gone from 630 to 430. So that's not happened. Now, that set in store an amazing setup for risk assets. I wish, and the big question, people watching this are couldn't you have told me that 30 years ago? And so let's talk about time travel. God, I'm really losing it. But because I recently did a discussive paper, the Obayashi Maru, which is a no-win scenario for Captain Kirk from Star Trek. And it's actually based, Obayashi is a common Japanese name, but it's based on a scientific polemicist who wrote a lot of what if we could go back in time? What if we could, like, I want to go back and tell you this. How would that change the structure of time? Because maybe we can invent time travel. What are the consequences? He was talking about that, and then it was picked up in Star Trek. And we'll touch upon that later, because I think where I'm taking you is to where the central banks face a no-win scenario. But it is fascinating, the time travel aspect. And what if you could go back 30 years and hear what I'm saying to you? Would it change anything? Again, I've mentioned in the past a wonderful short novella by James Buchan?
Yes.
Of the 39 Steps.
Yeah.
It's called The Gap, the gap in behind the curtain.
Yeah.
And the premise is time travel, or the premise is to be told the future. And there's a London financier, and he gets to read the front page of let's call it the Financial Times, and he sees this. He sees the merger, or the proposed merger of Anglo-America being taken over by
BHP Billiton.
And so imagine that a year in advance. What do you? And it takes some. You follow the course of his life in the next year. So I wish you'd heard this message 30 years ago. I think you're hearing this message really late on in that cycle. But I have to tell you, at the very end, there is an exponential acceleration which breeds the instability that brings it to the end. US stocks were on a tear throughout the decade of the 1920s, but it has to be said they were coming from a profoundly undervalued, like as a percentage of GDP, like maybe 35% of GDP. Today they're like, I think, almost 2.3 times GDP, so remarkable. But it was the last 2 years where it went hyperbolic. Okay.
Yeah. So a proper melt up.
And so the melt up that was happening in the late 1920s. What was happening was the UK was the US today. Was the old financial centre. Its currency was massively overvalued vis-a-vis gold. Left it deeply uncompetitive in trading. Left it with profound social tension owing to the high unemployment. And it left it with a very high interest rate. And the high interest rate back then was 4%, which is where the ECB finds itself. Yeah. Of course, the Bank of England, these jerks, I might go and do another video tomorrow. Where's Bank of England rates? 5.5%?
5.25%.
5.25%. Fed's at 5.5%.
Yeah.
You think I would know these things? 5.25%. So it's kind of that old ballpark. 100 years ago, but they were at 4%. And why were they at 4%? They were at 4% because people like me, financial speculators, like, it's overvalued, right? And you got to give me you got to incentivize me to take the risk that you stay on. You might come off the system. No, we're never coming off the system. Yep. We know how that worked out. But the thing is, in America, like with curb lending, so which is really like eurodollar system, you could lend money to allow people to buy stocks on margin.
Yeah.
And you were getting upwards of 20%. And I mean, that was 20% was a lot of money. Plus, you'd park your capital into the stock market, it'd go up, yeah. And plus, the currency, you're sitting there in dollars, and you knew that like dollar sterling was in your favor. Sterling would likely devalue, and that's what I want to say. The influx of capital. People are like, I don't want to invest in German opera houses. I'm going to lend you to invest in the stock market. You're going to pay me 20, and my float's going to be in the stock market. And the amount of money, that's what lifted the stock market. And the authorities could see this. And the Bank of England kept getting forced to try and push rates higher. And the Bank of England's like, we're going to get overrun, but we're going to become a communist nation. We can't hold this together, but we can't lower rates. And so it's like the idea was, we have to discourage you guys. You've got to bring your rates down. So the Fed did two very significant things. One that's less talked about. But the first one was the Fed cut interest rates initially by 25 basis points. And it was famously called the coup de whiskey. It was like effectively adding fuel to the fire.
Which I guess is J-Powell's concern now, right?
Oh, very much so. Absolutely. because the Federal Reserve is just one thing exclusively. It's the regulator and guardian of the domestic U.S. banking system and economy, right? That's it. Mission statement. It's not, we've got to rescue Thailand. We've got to rescue LTCM. We've got to rescue, Lehman Brothers, yeah? And sometimes it forgets that and it becomes more expansive in its discussion. So back then, it was more expansive and it explicitly tried to, so what it's trying to do is it's trying to bring this really, really high positive carry in holding dollar assets. They're trying to bring it down to alleviate and to bring interest rates down in the rest of the world, which are creaking and really, really struggling to keep their social tensions at bay. The other thing which is less talked about is the Federal Reserve went to all the private sector banks and they're like, stop curb lending. Curb lending by the private commercial banks in the US in the 2 years up to the crash just about disappeared. But it was, it went to zero, right? So this silo comes down, but Johnny Forer is like, well, if you need funding, I'm over here. And they put even more in. So, but the Fed, it was the interest rate cut and people flooded into US risk assets, because the Fed was taking its eye off the domestic.
But then I guess that alleviated the pain around the rest of the world in that case, because I guess other central banks could follow suit.
Well, so the Bank of England just really didn't get that much, and speculators it was the coup de whiskey. It was the rocket fuel that added to US assets. People were like, it actually accelerated the flow into the US, and it bred trees don't grow to the sky, and it bred the instability, and ultimately US equity prices fell on the weight of the great height that they had reached. So if we examine that, let's take that scenario. Let's take one aspect of that scenario, which is the Fed breaching its mandate and becoming this 007, this kind of agent to rescue the world from disaster, right? So we're in 1997, 1998, and profound things have happened. Interest rates are high. U.S. economy's motoring. U.S. economy back then is kind of like the growth locomotive of the world. But high interest rates, they're high because they're trying to tap the brakes. And tapping the brakes is a metaphor. You can break things. If you brake too suddenly, or the system becomes vulnerable to financial shocks. And we got it. We had more than 40% devaluations in Asian currencies. We had the sovereign default of Russia. And that was happening. And if I was there, I was like, I think something's going to break. Someone in the system will break. And you get to the third quarter of 1998, I want to say. And of course, is LTCM. Yep. And LTCM is monstrous. It's insanely large. And it can't fail. And they come in, they've got an eye on saving the world, and they've got this like Chernobyl nuclear plant. They cut rates. And people are like, you cut rates? Sorry, I think third quarter US GDP was like 5.6% growth. And they cut interest rates. Breach of mandate, right? So you protect yourself in real assets, and of course it coincided with the narrative in the internet, in the WWW. And so you had a profound concentration in very few stocks, which was the NASDAQ bubble. Okay,
so it's the final lighter fuel to that melt up.
It's the lighter fuel comes from they are moving away from their mandate. We've had profound suspicions about them as guardians of sound money, and now they've just proved it. And so I have to own real assets. Okay, so if you go to where we are now, 40% devaluation in Japan. So, and people, the retort is many things. Tokyo stock market's on fire. I mean, that's just the inverse of the currency, right? Currency that is...
And relatively, it's been not on fire for the last 25 years.
Well, 40 years. Yeah. It's just made a 40-year high. Yeah. And actually, it's absolutely going to do what Taiwan did. Taiwan was really naughty. Taiwan devalued back in that 97, 98 period. Didn't have to devalue. And this is actually important to remember. The Aesopian fable, the tarantula, whatever, scorpion, he needs to cross the river, and he asks the frog.
Yes, yeah.
And the frog was like, get out of here, like, you're dangerous.
Yeah.
You're dangerous cargo. I'm not risking it. Like, please, very, very, very persuading. And halfway across the river, scorpion, jing.
Yeah.
And the frog's like, man, you're such a badass. He's like, sorry, I was born that way, boom. And that actually is very, very relevant. So Taiwan, always methodical, great infrastructure, great companies at the cutting edge of technology, no imbalances, external balances, not a profound heavy load of sovereign of externally priced sovereign debt, like dollar liabilities. And they devalue right at the end of the system. And I was like, I didn't see that coming. Why did you do that? You're the frog halfway. Like, why did you devalue? Like, we're born that way. Like, our neighbors all devalued. Like, they're all taking a leg up on us. We couldn't let them have that advantage.
Exactly right.
And so you have to remember that with the what's happened in Japan. If you look at, we'll bring up in this conversation, you'll see the 10-year chart. But you can only do 10 because you get some weird, this better than me, the Korean won trading is a bit, it's a bit boxed, it's a bit regulated. And I look at candles, and you get these errant candles sometimes which the data systems don't fix. But we can show you 10 years, and yen is just, it's a teacup thing, and it's about to just really weaken. It's really, if it breaches these levels, which is why we're getting in the intervention. Remember, it's why the Koreans and the Japanese were with Yellen, because everyone's yelling at Yellen, they're screaming there's trouble coming. But if it's allowed to move like that, the Koreans will come around and they'll devalue. And the big daddy is, what does China do?
Yeah.
And does it need to devalue? No. Did Taiwan need to devalue? No. Why would they devalue? Because they're born that way. They're mercantilists. So we have to. This is really, really important point. So here we are. Let's go to the present, right? And the present, of course, is like, I don't know, it's 15 years after the great financial crisis. Mm-hmm. And from the lows, the S&P's up 4 times.
Mm-hmm. Yeah.
And so hedge fund guys, they try and, quite rightly, you can make a lot of money, but you can make a lot of money by going to a roulette table and getting lucky.
Yep.
And we kind of like people who make a lot of money, and it's just controlled. That they trend now. The apex or the extreme of that was Bernie Madoff.
Yep.
Okay. Now, purposely, I'm wearing my pajamas, I'm wearing a vest, I'm wearing Rolling Stones, I'm wearing a stupid hat, because I am the antithesis of Bernie. Bernie was obviously a fraudster. And you guys are suckers. You write your little notes saying that guy's a jerk, and I read it and like, screw you. Screw you, because you like the guys wearing the suits, they come in, they're very polished, and they got the great watch. Nonsense. And you're like, oh, he must be really, really smart. Yeah. Rubbish. And it's preposterous, but I have the most outer kilter life, and I see things. I don't understand why, and I will not polish and dress it up to convince you. It's on you. I'm the messenger. Anyway,
to present day.
And the great financial crisis, and I was saying that with the S&P's risen 4 times, but almost with a lack of so 4 times in 10 years is enormous. The starting base was enormously depressed, okay?
Yeah.
But still...
Doesn't feel like that, that's the thing, but anyway.
Yeah. But the degree of compression, oscillation, drawdowns for a 400% move, it's not been a wild ride.
No,
it's
exactly.
been impeccable,
yeah.
Okay? And it's explained partly by the 401k plan that you just can't beat. There is a persistent prevalence of a positive bias to stocks trending higher. Yeah. And everyone's like, well, I've got a 401k, my life is busy, and every month I'm going to allocate into a low-cost equity tracker.
Yeah, which is, again, a tracker on ETF has been the driver of that market, for sure. Or the flows into those.
Yeah, and it takes a lot, and there's so much inertia. You ain't going to change it. And anyway, like, market's going to be down 15, 20. And you're like, well, it usually bounces from there. I've got 15 years of data. It's fine. And there's a pain. I'd have to phone. I'd have to send an email. It doesn't happen. So the money just keeps coming in. But there's another source of money. And I was reading a very famous paper by George Soros in, I think it was 1984. And he was describing the imperial circle? And this was like from 1982, the dollar went on a tear, really strong. So again, 1982, US bond yields, 10-year, had peaked at something preposterous, 16%. And inflation was cascading lower. We'd had one of the most severe recessions in the US, and inflation was cascading lower, and ultimately treasuries caught a bid. And what's more, the economy caught a bid, and fiscal policy was actually quite aggressive. There were less hawks, and they were spending. They were spending. They were trying to get out of this really severe recession, and the dollar appreciated. And so you had the deficit spending kind of supercharging the private sector, and U.S. economic growth became faster than the rest of the world, and that attracts speculators.
Yeah.
Well, I want to join this party. The carry was still high on rates because they'd been elevated. The stock market caught a bid, and so it's not just what you get on cash. You're like, I'm making 20% a year in US stocks, and I can't see it ending. And then it all becomes reflexive, so that begets more foreign capital coming in, which begets a stronger dollar. The deficit spending, the hawks will tell you, is inflationary, but the strong dollar's actually
keeping it low.
Tethering and keeping it low, which then like people would then want to buy treasuries, and the yields are high and they're coming down, which means the price is going up, which means I'm overseas and I want to buy more, and as I buy more, the dollar goes up, the inflation is tame, the treasury prices go higher, and I want to buy more. And that went on until 1987. And you know, the dollar was really strong, and again, heads of state were like, you know, so US rates become quite high, and the rest of the world is struggling a bit, and they're like, we need help from the world central banker. But the world central banker is a domestic regulator of the US. And he's like, well, I can't do anything. And so the treasuries, so not the central bank, but the treasury ministers agreed to a coordinated currency intervention to try and sell dollars. And that caused, you know, the backlash from that was that flash crash in October 87. 50% in, was it 50%? Really huge move, 20% in a day. So again, we've had the US willing to succumb to, it wants to rescue the world. It's a benevolent hegemon, and I know that annoys people. It's benevolent, people. It tries to save you. So we have behind the surface, China was pursuing this very, very successful model. 35, 40 years, it's gone from the present day size of Turkey to the size of the European Union. Okay, and its currency has fallen modestly. And I've said to you, the mechanism for that is surplus savings, which get directed into buying risk-free US treasuries. Okay, and I'm saying, like 40 years ago, I wish someone had told me this, because no one fights. It's a perpetual machine that inflates US domestic asset prices higher and higher and higher and higher and higher and higher. Okay, and let me try and explain. So, and there was a mistake made by US fiscal authorities. And let's examine the period 2000 to 2007. All these sovereign nations with surplus savings, okay, want to put into risk-free. What is risk-free? It's a government treasury bill, or with a bit of duration, it's a treasury 10-year note. And it's not just the Chinese, it's the Germans. And you know what? It's actually a lot of the private sector. And there was $7 trillion in latent demand that actually came in, you know, but the US was run very fiscally conservative. I put the emphasis on fiscally, I meant conservative. And they ran modest deficits, which was to say the amount of new risk-free treasury bills that they created was nothing. It was less than $1 trillion. The demand is 7. And I've explained this to you before. Like J.P. Morgan et al. Wall Street invented risk-free securities via mortgage-backed securities. Yeah, and you go back and watch that to explain why they were risk-free. And so that money the opportunity that was missed is the US, a bit like MMT. Imagine another scenario where the US had actually run the deficits that they're running today, and all of those deficits would have been financed easily, and they'd have been financed by, if you will, their trade foes. The mercantilists would actually fund the upgrade of the intrinsic infrastructure of the US and the UK and Australia and elsewhere. And you could have had all of the ring-a-ding, whizzy things that the Chinese have with their fast trains and their bridges and their internet and these amazing conurbations and bridges that don't fall down and boats that don't crash into bridges bridges that fall down. We could all have that, and we could have had some revolution in education and healthcare and raised the potential of the American workforce. And it would all have been funded from overseas. We could have had that, and we know what the bill would have been. It would have been $7 trillion. But what did we do instead? We took $7 trillion and we caused like the most epic housing bubble.
Yeah.
Right? Because there's an alchemy. The Wall Street comes in like, you want risk-free? I've got risk-free for you. But then the risk-free feeds into the speculative boom in the housing market. And we know how that ends. Again, house prices, stock prices don't grow to the sky. They fall on the weight of their preposterous overvaluation. And that was 2007, 2008. So we have a crisis, but the money keeps flowing. Now, arguably the last 15 years were kind of perfect because, so behind the surface, money's all about private sector banks. Private sector banks create money. Now, you could say government's deficit spending creates money as well. Is it moot? I'm not going to dismiss that, okay? But I'm saying to you that up until very recently, deficit spending just not been a thing. And then secondly, domestic private sector banks have, again, there was the COVID period, but for the most part, have been reluctant to leverage and take their deposit liabilities and really gun loan growth. Loan growth has been kind of pedestrian within GDP growth levels.
Apart from a handful last year.
Yeah. Well, you're talking about the Silicon Valley Bank, but so the issue there was the deficit spending created this. It created what did it create? It created a huge liability for those banks. The issue for Silicon Valley Bank was that its deposit base tripled in 9-12 months. Tripled. Now, deposits are a liability. Now, you don't pay much on it, but it's a liability. It's an IOU. You put your money in, I'm going to return to you at any time, and I'm going to give you a rate of interest. And so you balance your books, and you have an asset. Now, banks have two assets. They lend, and so it's a loan, or they buy the treasury paper. And again, to the point I was trying to extol or whatever, the appetite to make the risky loan wasn't there. And so the Silicon boys are like, let's buy treasuries. Yeah. And they've been slammed, and I'm not extending an olive branch or sympathy, but it's the conceit and the arrogance. It was all kind of smart at the time because, hey, let's put it into 30-year treasuries with 2% yields, which is like, let's buy 30-year treasuries at the all-time high. And it's like, guys, it's cool because the regulator, the Fed, has said we can put it into a pocket called held to maturity, okay? And we might lose money. We might not, but it's not on us. Yep. If we hold it to maturity, this is risk-free.
Yeah.
And I don't want risk, okay? And those 30-year treasuries were then yielding 4%, and they were on a 50% loss, and they had an unmarked loss which was greater than their equity book. And people talk, and they need finance. And I was like, "You're dead. You're gone. You're gone." And it was the run on deposits. That is a situation which has not gone away.
Mm-hmm.
And you've seen the backup in interest rates again. The US economy is not slowing down. You know, we won't see 2% inflation for 2 years.
Yeah.
And Bank of America, its unrealized losses take out its equity book. That's not a scare story. What is fascinating is you watch or you go back and look at their quarterly earnings. Okay, I'm an analyst. Hello, Chief Executive of Bank of America. Wow, those results you just produced were amazing. Yeah. Hey, let's meet up for a cocktail later. And I'm writing a research note. Can you give me a commendation? Can you be my friend? Yeah. Where's the analysis? No one stands up and says, hey, can you give us an update? Hey, here's a message to Bank of America. Can you give us an update? Could you tell me what you've been doing with your, your held to maturity portfolio? Can you tell me how big is it today? Is it bigger than it was a year ago? Have you changed the composition? Is it now mostly 3 month? What's the mix between 3 month, 1 year, 5 year, 10 year, 30 year? We're updating our models. It'd be kind of interesting to know because last time we looked, you were kind of bankrupt if you get a run. I know you're never going to get a run. I know US house prices are never going to decline in unison.
And the Magnificent Seven are never going down again. Right?
They're never going down again. But could you just give me an update? Or could someone on Wall Street do their damn job and ask these damn questions? No one cares. Why do they not care? Because prices are going up. And the Bank of America looks like it's going up. Now the regional banks are really heavy in America. They're really heavy. And so there's the presumption. There's a great. That's an oxymoron. There are no great pairs trades. I've never made money from pairs trades. Yeah. Pairs long, short, and there's a commonality. And so the proposition today is you're long the 7 largest market cap. What do you call them? Strategically important giants, the JP Morgans.
Yep.
And you're short the KRE, the regional index. They will have problems. They can fail. The Fed will step in. The Fed will. And the pension regulator will take a hit, and you buy assets pennies on the dot, pennies from heaven, right? And so you see a trend which is very much in favor. That's a trade. But what if there is a run on Bank of America? But that's a big what if. That's for another time. But there's a latent. So where is that latent danger coming from? It's coming from. So concentrate, people. We said that the liabilities of Silicon Valley Bank tripled. And fact check that. Maybe it's doubled, but tripled. I want to say they tripled in 12 months. And when people talk about the inflation of COVID, they talk about M2. And M2 is essentially deposits. And M2 just went boom.
Yeah.
Okay. And that was deficit financing from the government. Now, deposits don't create inflation. I think we've just demonstrated that because the bank had a choice, and it went, okay, we've had this infusion of a lot of money into our bank, but we don't want to extend commercial risk, the extended risk without knowing it.
Yeah.
But they chose not to, right? And so that it's the loan growth rather than the deposit growth. I'm not a fan of M2. I'm hugely cynical of volatility. Volatility is just a word. It's a word which describes rapid movement.
Mm-hmm. Yep.
Rapid, uncontrollable movement. Yep. I want to say from the Great Financial Crisis, they had to step in. They had to rescue banks. They kind of increased the government debt, they had deficits, and then it was like, oh, we're going to be financially conservative. So that inflation genie kind of dissipates. You've got the private commercial banks like, oh my God, we went bankrupt. We are so ashamed.
Yeah.
And the government's up our ass. We're never going to do that again. We're never going to be reckless again. And so again, at the apex of that, I'm Silicon Valley, push for choice, I'm buying treasuries rather than extending loans. And I'm saying to you, it's the extension of loans that creates the inflation. So another agent dissipates inflationary powers in the last 15 years. And yet asset prices have been on a tear. So money's come from somewhere.
Mm-hmm.
And it's come from this thing called the eurodollar system. And the eurodollar system is a privately owned matrix, loose matrix, of banks operating overseas outside the sovereignty of the US. and is unregulated. The leverage levels, you can be as crazy as your counterparty allows you to be, because they all know each other, and that's a great discipline. It's like, actually, my counterparty is a knife at my back. Yeah. If I'm crazy, he's gonna buy 5-year CDS. I'm going to spike, and no one's going to trade. Now, so money creation has radically changed, and it's like you present collateral, treasury collateral. So I'm sitting, and I've got $1 billion of 3-month treasury bills, and I go to the discount window. Think of it as a pawnbroker. Yeah. I'm like, hey, now actually what happens is, this is overseas. So I say, I don't have $1 billion of US treasury bills. I've got €1 billion of 10-year Italian BTPs. How much dollars will you give me in return? And most days they're like, zero haircut. Like, I'll give you $1 billion. Okay. Now, as long as Italy, and why am I saying Italy? I'm saying Italy because you need deep liquid markets. You would prefer, your counterparty would much prefer that you produce German bonds as collateral, but they don't trade. The ECB's bought them all, so it's BTPs. BTPs are the money version of German bonds. It's like, fine, we'll take them. Or you present, let's go back to Japan. You present JGBs. No problem. Like, okay, no one understands the JGB market. It's been a widowmaker, but we just know that values are pretty damn sound. We'll extend you dollars. And so at the center, it's treasury bills. If you don't have treasury bills and you're overseas, you're trying to present to the pawnbroker Italian, German, British, Japanese bonds. And sometimes you might even be presenting AAA. There are not many AAA credits left, but you could certainly get away with JP Morgan debt, Apple debt. Sometimes it might even be a basket of equities. They'll give you a haircut, but they'll give you dollars. Those dollars didn't exist before. You've created dollars. And that's the manifestation. This is where the money comes from that powers two forces. It comes to that eurodollar system and the 401k, constantly thrusting equity prices. That ain't going to change. But let's discuss how it might change. So, and again, a reinforcing circle, because the Chinese keep producing surpluses. They keep buying treasuries, and up until the last 2 years, treasuries they've lost 50% of their value, but they've been on the biggest bull market ever. And there's still an argument that you could see something else. So Chinese keep a bid. The rest of the world keeps a bid. Everyone, banks are buying. Domestic banks are induced. You don't have to mark your portfolio if you buy treasuries. So there's a firm bid for treasuries. The big thing is, my lament is that the perfect foil and counter to the magnificent rise of China would have been great fiscal adventure in the trade deficit countries. Mm-hmm. That shame on us, we were too fiscally conservative. That changed with COVID. And actually, it wasn't just deficit financing, which is enormous. It wasn't just deficit financing. It was the nature and the precision of the spending. We finally gave up on it's something which failed the test. Tax cuts don't boost economic growth, right? And so again, back in the imperial circle, deficit spending, but actually it was tax cuts, and the economy was strong, but it didn't blow out, and the dollar was strong, and so inflation kind of tended lower. Where we are now is no tax cuts, proportionally high deficit spending, which actually is productivity enhancing the economy, but really, really pushing the US economy. It's now the US economy is the locomotive of the world. Now that's a problem, because this eurodollar system that's looking to create money from the collateral of US treasuries, it was conceived that all the growth would be elsewhere. They'd be in China, it'd be in Europe, it would be in South America. And so, and the 15 years were so incredible because the US could sit there and overnight carry rates would be zero. And so everyone could run debt levels very high and everyone was fine. It was stasis, but it was a comfortable stasis. The deficit financing, which was appropriate, has come right at the end of the cycle. It's still appropriate and it's giving the US economic growth. The dollar is rising, and so the inflation is not running away. I don't think this is 1970. I'm going to say it definitely. This is not presently for the next 3-4 years. It's not 1970s inflation. But in consequence, the treasuries have fallen, and now in consequence, they've fallen because you've gone from 0 rates to 5.25, and 10-year rates have to change. Yeah, we have a yield curve, but 10-year rates have prices have to change, and then Japan's the first one that's kind of fallen by the way, because people are like, well, I can sell yen at 0, I can immediately park it at 5.25, and now actually I've got to repay my yen in 6 months' time at maybe 10% less.
Yeah.
So, like, I'm going to do that trade every day.
Yeah.
And so the Bank of Japan's come in and say, well, we're going to make you think about that. What you got, you know. Because the thing they don't have, they've got lots of dollar reserves. They've got huge FX reserves, but they can't raise interest rates. Japan is like the UK getting kicked out of sterling. Remember when Norman Lamont, the Exchequer, he raised rates. Yeah. He raised rates, and he went to 12%. And Soros and Stan Druckenmiller are like, you got nothing.
Nothing left.
Like, your economy dies tomorrow. Like, you're bluffing. And who won? You know who won. And this notion that the Japanese are going to raise interest rates is preposterous, right? So, like, you know that they've been paying nothing on, you know, their price to perfection, whatever. But they have such a magnitude of debt that the servicing of the existing debt servicing is literally the same as the US government. US government's got, you know, like 5.25 rates. They've got 0. US yield 10 years are hitting 5 almost. But both countries are paying about 1/3 of total government revenues going to the debt service. And it's a slip. That's the descent into hell if that gets uncontrolled. So Japan's there at 0, and they're like, yeah, we're going to raise rates. No, you're not. No, you're not. If you do that, all of your government revenue will be consumed by your debt service. You're not going to do it. You're not going to do it. So all this intervention, I think, is fanciful. Anyway, so let's Jesus, I'm not being condensed. So we have an imperial virtuous circle. US is finally doing wise deficit spending. It's supercharged the economy. That's great. People have got jobs. It's smart. It's not tax cuts. The dollar's rising. The productivity enhancing expenditure means inflation is not going crazy, but it does mean that the carry for the world is being pulled to levels which are inappropriate. So we're back in the 1920s.
Yep.
The UK is at 4 today. We said it's at 5.25. And the UK is breaking. You know, look outside. It's like there's a mist. There's a pall. Yeah. There's always a pall, but increasingly there's a pall of gloom descending on this country. That, you know, like. So we're at the point where overseas needs the domestic US to slow down, or it needs the US Federal Reserve to cut interest rates. So this is where we come back to the no-win scenario.
But if we cut interest rates, then the whole thing just accelerates. It's like a double gearing.
Yeah. So if the Fed were persuaded to cut interest rates, it would be the coup de whiskey. It would in 1928. Mm-hmm. It would be the LTCM cutting interest rates, which preceded the Nasdaq blow-off. Okay, that's what. So we know what happens if they subjugate the domestic to save the rest of the world. I would be buying 10,000 calls on the S&P.
Yep, because it has a super acceleration.
Yeah. Now, I still think they might do that because, again, I know
Well, yesterday in Powell's minutes, it's funny how they changed the focus away from inflation, and now we have to look at jobs as well. They're almost arcing to find a way to cut rates irrelevant of what inflation is doing.
So it's Obayashi.
Yeah.
You know, the Fed knows. So where are we just now? It's I can borrow at zero in Japan. The likelihood is that my liability will devalue. So when I come to repay my debt, it will be less. I can get immediately 5.5%. Actually, I can put it into AI stocks or the grand seven. Probably make 20% a year, and I get a 10% deval against that. I make 30% returns. Yeah. What's my volatility? Nothing. I'm doing that trade every day, and so this wave of money's coming in. Fed knows that. It knows that this is very analogous to the late 1920s, and it knows what happened. So it doesn't want it to happen. But it knows if it cuts rates, it's gonna be an accelerant. So the only way the market's still pricing, I think, 1 or 2 rate cuts really at the end of the year.
Yeah.
I think if the rate cuts, they'll be before October, and I think it's because nothing to do with the election. I think that's one of those old horny dogs. Yeah. I mean, we had an election, the Obama election. George Bush. Where were they?
Mind you, I mean, JPL said yesterday this is irrelevant, right?
It's absolutely irrelevant. Absolutely irrelevant. But your forecast for Fed rate cuts should be based exclusively on the probability that you assign to something breaking. And typically it's a large financial corporation, or indeed another sovereign really being on the brink. And I think we're close to those levels where, and it typically happens over this time period, that September time period, where you get like a quarterly closing, banks don't want to extend risk and things kind of break. So if it happens, stock market has had a 5% drawdown. Mm-hmm. People's like, it's the dip, buy the dip.
Nothing, right?
Nothing, but in the last year, the biggest dip was 2.
Yeah.
So in the land of midgets, this is a gigantic drawdown. But if it's 20-25%, I think the Fed would cut. And it would be 20-25% again because there'd be systemic LTCM risk. Yeah. So that's that thing. But if they cut, again, I'm purposely choosing to be really low in equities presently. And my presumption is I think the chance they fall 20% and I can reload is more appealing than they go up 20% and I miss out.
But if we have a rate cut, that creates a second super cycle, doesn't it?
Yeah, you buy because that's my thing. I'm willing to forgo stocks just continuing to rally.
Fine.
That the 5 being the dip. I'm not buying the 5 dip because I think the upside will be limited.
But you think something has to break before we cut, so therefore the market will roll over before that happens.
The Fed needs an incentive, a profound incentive as it confronts the Obayashi Maru incident, the no-win scenario. What else can they do? So the status quo is do nothing.
Yeah.
And again, this is the central prevalence. The tendency is going to be for risk assets to trade higher. So if you do nothing, the carry is enormous in US. The deficit spending, we might see inflation flick to 4 or something. But it's going to roll over again. It's not going to be 6, 7, 8%, right? Dollar's going to be strong, and the capital flows are still going to come in, and they're still going to. So stocks are going higher, and it's a question of do they go really high because the Fed has the Fed falling and they cut to save the rest of the world, or do they're going to go higher? So I am not bearish, but I think because you've got a lot of private clients, and I think we should discuss. Risk allocation in this world, your risk allocation.
Yeah.
And so let me give you my personal anecdote. I look at it. My principal asset is a property in St. Bart's.
Yes.
Okay. Let's say it's valued at $10 million, and let's say I have $5 million of mortgage debt. Right. So my net worth is $5 million. Okay. The way I run is I will never allocate more than 10% into equities. Let's talk about gold next. Let's talk about Bitcoin, et al. Okay, so in 5 million, my risk book, my maximum risk book is 500,000.
Yep.
And I'm willing to be really courageous, but I don't want to lose 10% of my net worth.
Of course.
But that's where I stage it, and so I've got 500,000 to play with in this hypothetical scenario, and I've got to be invested. The central tendencies for risk assets to go up. And we're discussing, we might get a 20% drawdown in equities, but my God, it'll come back.
Yeah.
And equities might double in a preposterous final blow-off, and I want to be there for that. But we're talking about a lot of volatility is going to come in because the system is now creaking. So how much of that 10% do I want to allocate? Let's say I only want to allocate half of that. So I've got $250,000 to allocate, okay? And within that, I probably want 10% in equities just now, and I'd have the big 7.
Mm-hmm. Yeah.
So what is that? I'm buying 25,000. Okay. What else am I buying? Gold. So I think
even at an all-time high.
I want to buy gold because it's an all-time high. You know, we've had I think it's broken beyond the 2011 highs. We kind of we touched that with COVID and it failed, and it is breached and it's gone higher. And I think gold is the alchemy of chaos. Yeah. The system is becoming chaotic, and I've tried to take you through historical meanderings which say we're at the point of ultimate chaos, and that's where gold comes in, kind of in its own. So gold, probably want 50,000, 2x my equity allocation, and then I have Bitcoin.
And you buy physical or?
Oh yeah, how do you play gold? They upset me, but I've been getting upset I was flying over to Paris the other night, and I was like, guys, I give you genius. So what I want to discuss is, in gold, you should buy gold and buy what you want. Buy physical if you're more comfortable, right? The great thing about gold is there's no counterparty risk.
Correct.
If you own the physical. Yeah. I'll take the counterparty risk, because ultimately counterparty risk, if it's held with JP Morgan, is the US Treasury, right? They're going to honour it. They'll never break it. So I'd buy the ETF.
Yep.
And categorically, gold, when you volatility adjust, I'm going to explain that, your position vis-a-vis gold miners, there's never a period when gold, physical or ETF, does not match or outperform the miners.
Yep.
Buying a miner is like buying one of these 2x, 3x leveraged NASDAQ funds or whatever. The leverage destroys you because they get overwhelmed by small drawdowns, and it causes them to cut. So they're selling at the lows and buying at the highs, and it doesn't work. I think since 2004, gold is up 500%, and I think the ETF of major miners is down 9%. And that's before volatility adjusting. So within that period, without a doubt, there are periods when miners will have outperformed, and the gap between the relative performance of the miners vis-a-vis the metal is very, very clearly very, very high today. And it becomes, you know, the old Warren Buffett story. How does an oil speculator get to heaven? So there's this old grizzly guy. He's drunk a lot of tequila, been around for a lot of wild women. He's made a lot of money. You know, he's caught some gushers, and he's used to getting what he wants. And he's like, hey, St. Peter, it's me. Will you let me in? And St. Peter's like, oh, let me check. So you're an oil guy. Where are we with the oil guys? And he's like, dude, we're full. You're in purgatory. You sit on the bench, and I'll come back to you. And he's like, oh man, really? And so he's a genius. He's a hoary old guy, but he's a genius. He's like, hey, listen, just one favor. I'm on the bench, but one favor. And what? He's like, can I just say hi to the old guys? He's like, you got 2 seconds. So he opens the gates, and he says just one thing. He says, oil found in hell. And where do all they're like, and they all go to hell, the descent into hell. And St. Peter's like, wow, we're like, we have a vacancy for you, my friend. And he walks up to the gate, and he's like, there might be some truth in that room, and he goes to hell. And that's where gold people are with the miners. You categorically prove that it's a dumbass. It's a fake. Always buy the metal. And what did they say? No, I'm going to hell with the miners, right? So the volatility adjustment means historically, I think gold's moved with a cadence like, so if you measure the daily price variations, that's called volatility. And we were seeing the majesty of the S&P going up 400% is that it's kind of gone up without wild gyrations. It's been kind of tame. And that's good. And that's like gold. The miners, they might fall 50, 60%. They might rise 300%. They're what do you call it? A bronking bonko?
Yeah.
Is that what you call it?
A bucking bronco.
Bucking bronco. They're bucking bronco.
That's a good spoonerism.
And you get unseated. So again, within my methodology, I've got 10 million property, 5 million debt. I've got an investment portfolio of $500,000. I said to you 50,000 in gold.
Yeah.
Now, okay, if you're going to hell, buy of that 50,000, like you'd have to buy 10, 15,000 in gold miners. That would be the equivalent. You'd be much better just putting 100,000 in the metal. But if you're not going to do that, put 15,000 in the miners, and then you will complete the journey.
Yeah.
Okay, don't go to hell, people. Please don't go to hell. And then the last thing is, the last cycle round, I call it Bobby Digital. Bobby Digital is a member who came out of the amazing US kind of hardcore rap band, the Wu-Tang.
Yeah.
The Wu-Tang. And anyway, Bobby Digital. Bitcoin is Bobby Digital. And again, we'll present a chart. And you're going to see that in the last 5 years, I think, there's been an enormous gyration in the RV, the relative value of Bitcoin to gold. Okay, I wouldn't recommend that. I'm not recommending that trade.
Yeah.
Again, it's too volatile. But what is it saying to me about the relative attractions of Bitcoin and gold? I think this chart that you're probably looking at now is going to break to the upside, which is in favor of Bitcoin. Why am I saying that? I'm saying that because I'm not a genius on the blockchain, etc. But I'm kind of a genius with how markets work. Okay, and Bitcoin it's in a classification that we call alternative assets. You'll know it very well. What do we have in alternative assets? We have gold. What's the size of gold today? 17, 18 trillion dollars. Okay. What else can you have? Index-linked securities, TIPS. Geez, I don't even know what they are. They're 20, 30 trillion dollars. You've got private equity. What is private equity? Must be minimum 50 trillion dollars. You've got commercial property. Commercial property is like $100 trillion, right? What's the size of Bitcoin? It's like $1.5 trillion. It's tiny, right? And so for me, I will over allocate to Bitcoin. Mm-hmm. I can own both of them. They're both going up, but I'll over allocate to Bitcoin until that disparity in their valuation narrows substantially. So I'm bullish on gold, but gold at $18 trillion, if it doubles, it's $36 trillion. 30 that's quite full. Mm-hmm. The world economy is $100 trillion. Yeah. Gold would be like 40% of the world economy. That kind of seems like where it should trade. So I make 1 times on the upside. Yeah. Bitcoin could be 5 times, if not more. So again, where am I? I've got $25,000 in the crazy big 7. I got 50,000 in gold. I keep changing this on but I'm trying to kind of coalesce around it. And I've probably got 75 to 100,000 in Bitcoin. Okay, and that's my portfolio. But of that, I was allocating 250. Yeah, I'd be long $250,000, and I'd be short like probably 50-50 yen and the Chinese currency. And then I am. So I'm not bearish, people. I'm just saying we're at the anarchy end of a 40-year cycle. The great lament is that we didn't have more nuanced fiscal adventure by the US authorities like in the 1990s and the noughties. They've got it. They got it at the end. I'm bringing to your attention that there is this phenomenal carry machine that's just channeling more. It's the Fantasia, where Mickey Mouse steals the sorcerer's book, and he gets all these mops, and they're taking the water, and suddenly there's more and more and more liquidity, and it's mayhem because prices
go somewhere,
and they go to the moon. Yeah. That's where we are. and it's probably going to go further, and I want to participate in it. But if it all ends, I'm worth 5 million, and I might lose 250,000, and I won't lose 250. Oh, because I didn't mention, I would have 50,000. I'd always like quarterly. I beginning of this process, I'd have bought $50,000 in at least 1 year. Well, leaps are 1 year forward. Options on TLT, the longest duration government bonds, and periodically they go to zero because they've been shit. And I just like every quarter, like I have to maintain $50,000. That underwrites everything else I'm doing. So I'm not going to lose 250,000. It's again, it's nuance. I'm glory or gainer. I am the survivor.
Hugh, this has been absolutely magic. It's good to have you back. It's good to have you back on such great form. Look forward to seeing you again soon.
Thank you. Well, you bring the best. This is my happy place. Thank you.
Hugh, it's been brilliant. Thank you.
Thank you.